Let's go
The
to Peter.
taper has begun. The Fed is reducing its bond buying, Tom, by $10 billion starting in January. MBS purchases being reduced to $35 billion from the current $40 billion. Treasuries being reduced from $45 billion to $40 billion. We also have new forward guidance language as well, and they will continue to reinvest principal payments. They are saying in their statement, the Federal Open Market Committee, in light of the cumulative progress, the committee is modestly reducing its bond buying. And it says in the statement looking forward, if incoming information broadly supports the committee's expectation of ongoing improvement in labor market conditions and inflation moving back toward its longer-run objective, the committee will likely reduce the pace of asset purchases in further measured steps at future meetings. However, asset purchases are not on a preset course. Now, let me read you again a change here with regard to forward guidance on interest rates. The threshold of 6.5% unemployment still remains in the language, but there's this new line here. The committee now anticipates that it likely will be appropriate to maintain the current target range for the federal funds rate well past the time that the unemployment rate declines below 6.5%, especially if projected inflation continues to run below the committee's 2% longer run goal. There is some new language here with regard to the economy as well. Let me share that with you quickly. The economic activity is expanding at a moderate pace. Labor market conditions have shown further improvement. The unemployment rate has declined but remains elevated. Household spending, business fixed investment advanced. While the recovery in the housing sector slowed somewhat in recent months, fiscal policy is restraining economic growth, although the extent of restraint may be diminishing. Inflation has been running below the committee's longer-run objective, but longer-term inflation expectations have remained stable. And just finally here, the committee sees the risks to the outlook for the economy and the labor market as having become more nearly balanced. The committee recognizes that inflation persistently below its 2% objective could pose risk to economic performance. It is monitoring inflation developments carefully for evidence that inflation will move back toward its objective over the medium term. The vote here was not unanimous. Eric Rosengren, the Boston Fed president, dissented, saying that this move was premature given the economic conditions. I should also point out that there are additional releases coming out at this hour. There's a second statement describing the beginning of the tapering, the actual mechanics of that with the FOMC decision here. Again, summarizing basically what we heard in the statement itself. And there's also the summary of economic projections being released at this hour on a quarterly basis. Those economic projections, no major changes noticeable in there, no big moves from the Fed. But let me highlight one in particular.
Please.
2014, the unemployment rate, 6.3 to 6.6% is the central tendency again for 2014. And when will they start hiking interest rates? The FOMC members, the 17 members who get a say at the table, get a vote here. They say now 12 believe it'll happen in 2015. Just 2 say it'll happen in 2014. 3 say 2016. And in terms of the pace of tightening, where will rates be at the end of 2015? 12 have the Fed funds rate at 1% or lower at the end of 2015. 14 have it at 3% or lower by the end of 2016. So the message in this statement is the taper has begun, but a message as well to the markets that accommodative policy, don't expect rates to be going up anytime soon. But the taper, Tom, officially underway.